In March of 2010, the Jamaica Deposit Insurance Corporation, JDIC, staged the first Caribbean Bank Insolvency Conference at the Rose Hall Resort and Spa in Montego Bay. Over 20 experts from countries across the Caribbean, Canada, the United States, and United Kingdom spoke on issues relevant to the global financial crisis, international initiatives towards best practices, and resolutions for bank insolvency. In today's episode, we'll feature highlights of the presentation given by the CEO of the Malaysia Deposit Insurance Corporation, Pierre Sabourin. Mr. Sabourin spoke to the role of deposit insurance in maintaining financial stability. You'll also see that of the Regional Counsel for Dallas at the Federal Deposit Insurance Corporation in the USA, Donald McKinley. Mr. McKinley addressed the history of deposit insurance, expanding powers from 1933 to present. Donald McKinley is Regional Counsel for Dallas for the Federal Deposit Insurance Corporation of the USA. Mr. McKinley's responsibilities include banking law, bankruptcy, and commercial loans.
There was a paper presented by an individual who studied different deposit insurance systems and receivership systems, and they came up basically with the three different models. So this may be more familiar to others, but one being the pay box model, where simply the agency is responsible for the delivery of the deposit insurance but does not act in a receivership mode. Then we have the paybacks with extended authority. And that one there, the agency may be responsible for both the deposit insurance and have the additional ability to serve as receiver of the bank. So that's a pay box extended. And then I guess we have the next category of the risk minimizer, and this I guess is pay box extended plus, if you will. So we tend to follow into that third model right there that came about. I do want to mention the FDI Act of 1950. I only note the 50 Act in the sense that somewhere in my recollection of the history of FDIC, there's that exchange that pretty much set the discussion that continues on through this day. Of course, probably the most significant, a couple more significant pieces of legislation for us, the FIREA legislation in 1989, setting up the two different insurance funds, the BIF, the SAFE, dealing with the rescue of the savings and loans industry at that particular time, also creating the five-member board. But for me, and for those on the receivership and resolution side, virtually every one of our special powers, our authority, our ability to administer receiverships came through and exists through that particular act right there. There's really no silo effect. You learn from your open bank experience, you learn from your closed bank, resolution, receivership experiences, and when the chances and the opportunities come, then you migrate those experiences into legislative enactments. And so for FIREA, much of the authorities that we have to act as receiver, and even in terms of our resolution opportunities, come through that particular act. And then through FDIC, next major piece of legislation there, FDIC then again migrated from, basically the assessment scheme went from a flat-based assessment scheme to now you're talking about risk-based premiums. You're talking about a $30 billion line of credit, from the borrowing authority from Treasury if you need it. We haven't used it. You're talking about the line of credit. You're talking about prompt corrective action and the ability to close banks, when the capital level gets below 2%, a very, very pivotal piece of the way we do resolutions. I just wanted to point out the RTC Completion Act. Again, outside of bringing the RTC to a close, a federal agency that actually sunset when it was supposed to sunset in 1993, FDIC taking over the function. And I guess my whole point is it's a progressive history, and I think the thing that I keep coming back to is, like we were talking about yesterday, we just keep learning from different experiences. We try to update those experiences, and when you combine and you don't have a silo effect in the way you're operating, you're blending your experiences as a regulator, you're blending your experiences as a supervisor, you're blending your experiences in terms of managing failing banks. That's going to manifest itself in the type of legislation you draft. In terms of deposit insurance, the FDIC, the way the FDIC Act provides is that you can actually, it's set up based on different types of ownership categories for different types of accounts. Everything we can do to minimize the disruption and deliver deposit insurance promptly and efficiently to those customers like that. Once that act got signed in 1933 and the FDIC was created, the number of banks that failed subsequent to the enactment of that act just dramatically dropped. There was almost an immediate effect in terms of public confidence. So I guess the point there is we've really dramatically gone from a change from the flat rate structure to a risk-based premium system, collecting them upfront to fund the deposit insurance fund. The most important thing that we have out of this is that the resolution process starts far before the time when a bank's actually closed by the regulator. The more time we get in advance before a bank closing, the better time we have to market that bank and to receive value on that bank and to receive the best possible return for all the creditors involved for that particular institution. That's how we use that time. It happens way before a bank is ever declared insolvent. We're already working on that. In terms of what FIREA did for us is take much of the common law, our special powers, and now we have those codified. Many states started adopting depositor preference before FDIC did. And so in 1993, that became federal law. But states like Oklahoma, Texas, numerous other states, Virginia, started enacting depositor preference, and in many cases originally designed to assure that their depositors in their states would have a higher chance of receiving full protection if their bank was to close from FDIC, as opposed to the prior mechanism, which was primarily everybody was treated ratably as far as a creditor of the estate. There was no distinction between a depositor and a general creditor of the estate. They were all treated ratably for distribution purposes. So every time you look at one of these items, they're usually the result of some other prior experience that then ultimately gets incorporated into some legislation to more significantly enhance our abilities to administer that receivership like that.
Jean-Pierre Sabourin has been the CEO of the Malaysia Deposit Insurance Corporation since its establishment in 2005. He is also chairman of the advisory committee of the International Center for Leadership in Finance.
As any regulator would know, the phrase financial stability is a tricky concept, only because it envelopes the complexity of risk analysis, market constituents, and policy formulation. Above all, financial stability is not a static condition, but occurs at a continuum. So where are we in the continuum today? Are we now experiencing a return to stable financial economic systems? One point that must be highlighted during these troubled times is the importance of maintaining public confidence in the stability of a country's financial system. As governments and their agencies provided support to the financial sector, depositor protection provided confidence to the public that their savings would be protected. The crisis has shown that things can and change rapidly when one least expects it. And when it did, it severely challenged the capacity of many deposit insurers systems who were simply not supported by the right mandate, the tools, the funding, or the resources. I've identified 8 key financial stabilization roles of deposit insurance during normal times. An effective deposit insurance contributes to the stability of the system in good times by first maintaining public confidence, contributing to greater economic development, promoting sound risk management, providing independent risk assessment and monitoring, promoting market discipline, promoting competition, supporting supervisors, and supporting the payment system. Having covered the role of deposit insurance in good times, what is their role in times of crises? First, deposit insurance can prevent disruptions of the payment system, which I've just mentioned, by promoting public confidence in the system. And public confidence can be maintained if depositors are convinced that the deposits that are protected are safe. Second, a credible deposit insurance system can maintain and reinforce public confidence during a crisis if it is able to implement quickly a set of crises mitigating policy measures. Third, deposit insurance can provide emergency funding assistance to troubled financial institutions, either by way of cash injection, providing guarantees, or purchasing assets. Last but not least, deposit insurance can provide the expertise for early intervention and resolution of problem banks. In addition to serving as an important check and balance, in the financial safety net, a deposit insurance system with intervention powers, early intervention resolution powers, is most often mandated to meet those in least cost resolutions. Let me now move to discuss some of the critical success factors for deposit insurers. It's stating the obvious that good governance and organizational arrangements are vital to the effectiveness of any government institution, including the deposit insurance system, in carrying out their public policy objectives. Here I've identified 6 factors that are critical to the effectiveness of the deposit insurance system. There are strong mandates and powers, sound governance and operational independence, ready access to funding, effective public awareness campaign, flexibility in dealing with bank failures, and close cooperation with other safety net players. As regards to mandate and powers of deposit insurance, I'd like to draw attention to 3 important points. The recent crisis revealed that only deposit insurance with broad mandates and appropriate powers can build and maintain public confidence and deal with financial crises effectively. Financial system is stable only when the public believes that a financial system is safe, strong, and that their funds will be readily available at all times. To gain public trust, a deposit insurance system must first be credible in the eyes of the public. It needs to demonstrate to the public on an ongoing basis that it is well governed and well managed. Integrity and effectiveness of operation can be enhanced by having in place a strong governance system. Comprehensive business plans that are made public, including establishing key performance indicators, a robust enterprise risk management framework, and sound accounting and internal controls. And to ensure that public confidence remains when banks fail, deposit insurers have to build credibility in good times. There is no doubt that the deposit insurer can and does maintain public confidence at all times if it is effective when, or it is most effective when it is operationally independent, it has legislative authority to access all supervisory and banking information at all times, and it is legislative mandated to intervene early and find least cost resolutions. Public awareness, as was pointed out earlier, is the deposit insurer's key tool to create a well-informed depositing public and to promote public confidence in the stability of the financial system. The provision of timely and accurate information and financial education is a strong antidote to unwarranted fears. But I hasten to add that the corollary of having powers is the need for the deposit insurer to be held to account, and there must be mechanisms to balance the interests and rights of effective stakeholders such as creditors and shareholders. But I stress only after the resolution has been completed. I'd like to just talk about close cooperation with other safety net players. And one point is that, that when crises now evolve very fast and more come in future to be effective, we need all of the toolkits necessary, varied and flexible as the problems themselves. And this is really necessary, and why is that? Because we will have other financial crises. Therefore, clear legislative mandates and formal arrangements are essential to ensure and cement smooth cooperation and goodwill among safety net players. As the saying goes, good fences make good neighbors. Hopefully, this crisis will bring about renewed efforts by public policy officials to move ahead decisively on addressing cross-border issues relating to systemic banks. Indeed, the development of initiatives such as the requirement for systemic international banks to develop living wills to deal with their demise in a structured way is a big step forward.
In our next episode, we'll feature the presentation made by Principal Economist in the Financial Affairs Division at the Organization for Economic Cooperation and Development, OECD, Dr. Sebastian Schick. We'll also bring you that of Reader in International Banking and Finance at the University of Leeds in the UK, Andrew Campbell.